Hi, everyone. Okay, this is going to be a lecture on part 2 of chapter 14. Essentially, I'm going to do a recap of objective 4, which talks about DNI, distributable net income. And then I'll go into objective 5, which covers determining a simple trust taxable income. And then the last thing I'll talk about is determining taxable income for complex trusts, which is covered under Objective 6. I'm not planning on lecturing on Objective 7, income in respect of a decedent, although I do want you to read about it. Nor am I going to cover grantor trust provisions or tax planning considerations or compliance and procedural considerations. Those are, I think, fairly easy to walk yourselves through. I think the meat of this chapter is around calculation of DNI and a distribution deduction and taxable income in the case of both a simple trust and a complex trust. So I do want to recap a little bit on DNI. We touched on that during the last lecture. But the significance of DNI is both to set the ceiling on the amount of the distributions which are going to be taxed to the beneficiaries, and also to set the ceiling on the maximum amount that can be deducted as a distribution deduction at the fiduciary level, at the trust level. So it's a really important concept. And there are several different approaches to calculating what the maximum distribution deduction is going to be, and also what taxable income is going to be. And the reason they've come up with these, long approaches versus shortcut approaches is that there is the formula for calculating DNI and your distribution deduction are a little bit circular, in that taxable income includes a deduction for a distribution deduction, but the DNI and distribution deduction can be two different things, and you have to calculate DNI before you can figure out what your distribution deduction is going to be. So I don't want to say it gets complicated, it's just kind of tedious, and you need to make sure that you're following the formulas and reading the rules. And when you come to a problem, just take it nice and slow and think about, what do I do if I've got tax-exempt interest income? I know tax-exempt interest income is not taxable for taxable income purposes, correct? That's why it's called tax-exempt income. But it is included in your calculation of DNI. And so therefore, it's going to affect your distribution deduction. So you need to make sure that you're kind of keeping track of, what do I do with tax-exempt interest income, both for taxable income purposes as well as for DNI and distribution deduction purposes. Same apply, and then for net accounting income purposes, NAI, net accounting and a net accounting income and your distributable net income are essentially going to be the same, except for some complicated scenarios which we're not going to touch on in this context in this class. They don't even talk about it in the book, so you guys don't need to worry about it, and it's not going to come up in any of your problems. So for the purpose of what you're learning this semester, just know that NAI, net accounting income, and DNI, distributable net income, are going to be the same. So you know that starting point is going to be the same. Now we know that net accounting income includes tax-exempt income. So right there, we know that if we have tax-exempt income, our calculation gets a little bit complicated in that we know that now our taxable income does not include something that's in NAI and also in DNI. So that's why I was saying in my last lecture, there are potentially three different calculations that you need to do when you're doing your, trying to figure out your taxable income. And that is, you need to know what your net accounting income is, you need to know what your DNI is, and then you need to know what your taxable income is. And once you know all of that, then you can calculate the distribution deduction that's going to reduce taxable income. Because typically when I'm talking about what is taxable income, in the case of a trust, I should be talking about taxable income exclusive of the distribution deduction. Because if I start with a figure that I think is taxable income inclusive of the distribution deduction, I could have a problem, right? Because I know that DNI sets the ceiling on how much I can deduct as a distribution deduction at my trust level. So when we're talking about trusts and we're talking about taxable income, we need to make sure that we are excluding any distribution deduction from it first when we start doing these calculations. Okay. DNI is going to determine the character of the beneficiary's income. So what that means is when you pass through the income that's going to be taxable to the beneficiaries, or that's going to be in their gross income, even though their gross income does not include tax-exempt income, they are going to be deemed to be distributed a piece of the tax-exempt income. And it's not taxable to them on their tax return, but it is going to be deemed to be distributed to them. So that's what this third bullet is talking about here. So in calculating DNI, we need to understand how it's defined. So essentially, it is your taxable. There's two ways to calculate it, but the easy way to calculate it, if you're starting with taxable income exclusive of your distribution deduction, and that's a pretty easy calculation to calculate if you know what's in taxable income, right? And especially in these problems, you're going to know what's in taxable income because you guys have been through many chapters now in the book, and you know that rental income and interest income, unless it's tax-exempt interest income, which it will say, the rental income and interest income and dividend income, that all goes into your calculation of gross income. And then you reduce gross income by expenses that we talked about in the last lecture, which are covered in the first part of this chapter, like trustee fees and other administrative expenses, accounting fees, and then you also get a personal exemption if you're required to distribute all of your income each year, and trusts that are required to distribute all of their income each year are defined or spoken to, referred to in the regulations as simple trusts, then you get a personal exemption of $300. If you aren't required to distribute all of your income, and you actually don't distribute all of your income, and if you're not required to distribute all of your income, those kinds of trusts are referred to in the regulations as complex trusts. And but the personal exemption is derived by looking at whether all of the income is actually distributed or not. So in a simple trust scenario, you know that you have to distribute all of the income each year. So you are automatically given a personal exemption of $300. In the context of, in the case of a complex trust, you aren't required to distribute all of your income annually. But if you do, then you'll be treated like a simple trust in relation to the amount of personal exemption that you get, which will be $300. Otherwise, a complex trust, if it doesn't distribute all of its income, will get a personal exemption of $100. So all of those expenses would reduce your gross income to arrive at taxable income before the distribution deduction. So that's this top figure here that we start with when we're calculating DNI. And then we add to that figure our personal exemption. So in other words, DNI does not, and you do not include a personal exemption when you're calculating DNI. You add that back. And it does include tax-exempt interest income. So you add that into your taxable income figure, because you know in this first box here it won't include tax-exempt interest. And then you add back to taxable income any capital losses that you took, that you reduced your taxable income by, and you subtract from DNI any capital gains that you included in your taxable income. So you know that if you have capital gains of $10,000 and capital losses of $4,000, that's a net $6,000 capital gain. That will be included in your taxable income figure. What they're essentially saying here is you need to wipe that out. You need to back it out in order to arrive at DNI. So you can see here that when we get done doing all this, we end up with net accounting income. And that's why they say in the chapter, DNI is essentially the same as net accounting income. Because if you remember if we go back, so if we look at what's included in your fiduciary, your net accounting income, we see that current return from a principal asset plus rent plus interest plus dividends, as well as capital dividends, all of this is included in fiduciary net accounting income. The stuff on the right is not included. You would include capital gains in your calculation of taxable income, but only net accounting income only includes the stuff on the left. So I'm trying to see if there's an actual, I don't think there was an actual like formalized calculation of net accounting income. So if we start with taxable income exclusive of the distribution deduction, we add back in tax-exempt interest, and we subtract out our net capital gains, and we add back our personal exemption, we will arrive at DNI. Now, let's see. There are two methods of determining DNI, and the first one that we can use is the one that we just talked about. That's That's what I call method 1, and that's covered under your example 14-13. Hopefully it's that in your book. It's about the Darby Trust. And that's a nice example to go through that illustrates this method of calculating DNI. But there's also another method that you can use to determine DNI, and that's essentially where you basically start with your net accounting income, if that's what you're given in your facts, and then you would reduce that by, because now if you're starting with net accounting income, it's already essentially backed out the net capital gains and included the tax exempt interest. And of course, the personal exemption will not be included in your NAI, your net accounting income, because it's a book income concept. So if you start with NAI and then just reduce NAI by expenses that are charged to corpus, to your principal, like your trustee fee, then you will end up with, that's another way of calculating DNI. And the reason you do that is because if you have expenses that are charged to corpus, i.e. trustee fees, sometimes some portion of trustee fees will be charged to corpus and some will be charged to accounting. Well, when you have some of the trustee fees charged to corpus, that portion of the trustee fees is not included in your calculation of NAI, because as I was showing you a minute ago, you only reduce from NAI the portion of the deductions which are deemed to come out of income, not those portion that are deemed to come out of corpus or to be charged from corpus. And that'll usually be discussed in the trust instrument. So that's how you'll know that in the context of this class, it'll give you that information in the facts of the problem. So you'll know what to do with that. So now remember, even though half of the trustee fees might come out of principal and half might come out of income, the whole amount of your trustee fees are deductible for taxable income purposes. So you can see how using these two different approaches that are discussed in the book will still help you to arrive at DNI. So you might want to go through those two examples in the book. C14-13 is method 1, which is this method. And then method 2 is right below it, C14-14. And it talks about the second method where you're starting with NAI and then you just reduce it by expenses that would have been charged to corpus. Okay. When we are determining the taxable income of a simple trust, we might have a situation where the income for the trust is coming from both taxable and non-taxable sources. So it might have some taxable interest income, and it might have some rent income, and it might have some tax exempt income. So now it's got income coming from taxable and tax exempt sources. And if that's the case, what you need to do is you need to allocate the expenses that are not directly attributable to the production of taxable income. You need to allocate those between expenses that are going to be allocable to your tax exempt income and your taxable income. So in your example in the book, an example of an expense that would be directly attributable to rent income, for instance, might be a repair expense for the rental property from which you generated rental income. So that repair expense would be directly allocable to your rent income, and therefore it would not be, you would not have to allocate part of that expense to your tax exempt expenses. Now, why are we doing this? We're doing this because for taxable income purposes, there is going to be some portion of these non-directly allocable expenses that are going to be allocated to your tax exempt income. And we know from what we learned before that any expenses that are allocable to tax exempt income are non-deductible, and that's because the tax exempt income is non-taxable. So now an example of an expense that's directly allocable to tax exempt income would be like a investment advisor fee. Now, an investment advisor fee is directly allocable to the production of income, interest income and dividend income, and even capital gains and losses that would have been generated by the principal that's put into, let's say, Fidelity or Charles Schwab. And you have an investment advisor taking care of that principal for you and helping you to decide how you're going to allocate the principal, what kinds of funds you're going to put it in. However, those investment advisor fees, if you're earning both tax-exempt income and taxable income, then those investment advisor fees would also have to be allocated between your tax-exempt income and your taxable income. So if you have that case, then what you do is you use the following formula. You take your net tax exempt income, which is essentially equal to tax exempt income minus expenses that are directly attributable to them, and you divide that by your net accounting income, net of direct expenses. And in our case, that was like rent income minus the repair expenses on that rental property. So it's that fraction multiplied by all expenses that are not directly attributable to any kind of item of income, whether it's tax exempt or taxable. And that's because we've already netted in our fraction all of the directly allocable expenses. So now we're just trying to allocate the not directly allocable expenses. And when you multiply that times this fraction, you will come up with indirect expenses allocable to non-taxable income. So if you had started with $100 here and you end up with $50 here, because this fraction is 50 is 1/2, ends up being 1/2, then you will end up with $50 of your indirect expenses allocable to non-taxable income and $50 of indirect expenses allocable to taxable income. So you're going to need to understand how to do that calculation in order to do some of the problems. Okay. Said even another different way, when we're talking about DNI and how to determine the distribution deduction, with regard to simple trusts, because all net accounting income, your NAI, has to be distributed each year, and that's just a requirement of a simple trust, your distribution deduction is usually, as a general rule, going to equal your NAI. The exceptions for that are that your distribution deduction cannot exceed DNI, and there's no distribution deduction for net tax exempt income contained in DNI. So what this essentially means is that if you do have net tax exempt income, and that's basically tax exempt income, like tax exempt interest income, less any expenses that are either directly or indirectly allocable to tax exempt income. The result is going to be net tax exempt income. Those amounts are not eligible for a distribution deduction, so you would have to reduce your DNI by the net tax exempt income to arrive at your distribution deduction. And the reason for that is because the trust gross income, and gross income is actually a tax concept. It essentially means taxable income before, gross income is a tax concept. Don't think of it as a book concept or a book nomenclature. Gross income is tax nomenclature for taxable income before tax deductions. So because the trust gross income, i.e. the income included in taxable income, is not included, tax exempt income is not included in trust gross income, then you're not going to get a distribution deduction for that. Hopefully that makes sense to you guys. Now, when we're calculating the treatment for the beneficiary, seeing whether, I think it's going to be down here. We need to basically, we might have more than one beneficiary, and we might have a case where DNI is actually smaller than the distribution deduction. So if we do have that case, then the beneficiary's share of gross income is going to be equal to DNI multiplied times the income to be distributed to that particular beneficiary over the income required to be distributed to all beneficiaries. And that's how we calculate each beneficiary's amount or share of gross income. And that's in the case where we have more than one beneficiary and where we have DNI, which is smaller than our distribution deduction. There's a nice example in the book on this. It's C14-16, and it's I'm not going to go through it right now, but I mean, I would suggest that what you do, and what I did was I kind of went off to the side in the book. It kind of helps if you do the calculation yourself as you're reading through the example. So I calculated NAI first, and then I also calculated DNI. And remember, I told you that DNI and NAI are essentially going to be the same unless you have a situation where you have some of your trustee fees or some of your expenses coming from corpus, because that, of course, would not have been included in the calculation of NAI, because NAI is just a net accounting income, not principal calculation. So in order to arrive at DNI, you would have to subtract out the $8,000 worth of trustee fees coming from the corpus to arrive at DNI. So they give you what DNI and NAI are, just in the facts, but I actually calculated them off to the side, sort of in a formula approach, so that I could see for myself how I'm calculating it. And then from there, you can just read about how they came up with the amount of income. Another thing in this example that's in the facts actually is the required distribution to Matt and to Pat. That's just the requirement per the trust instrument. But what you're trying to figure out now is the cash distributions to them, which are going to be includable in their gross income, and the portion of those that are going to be made up of tax exempt interest versus taxable income. So you need to know that so that you can put that, so that the beneficiaries can put that on their returns correctly. So if you have a net operating loss, they do not pass through to the beneficiaries. Even though a trust is considered to be a fiduciary, well, it's a fiduciary entity, but it's also a conduit entity, meaning that items of income and expense actually pass through via distribution deductions to the beneficiaries. In the case of actual NOLs, those don't pass through to the beneficiaries unless the loss, the NOL, arises in the year that the trust terminates. However, if the trust does have NOLs, then they can carry back and forward those NOLs and use them against trust income, trust taxable income at the trust level. So just remember that except in the case of the year in which the trust terminates, the NOLs have to remain at the trust level in terms of them being used. Also, for net capital losses, the rules are the same as they are for individuals. So the maximum amount of capital loss that a trust can deduct is limited to the lesser of $3,000 or the excess of its capital losses over capital gains. So for instance, if the trust had a $20,000 capital gain and a $22,000 capital loss, their net capital loss would be $2,000. Because that $2,000 is less than $3,000, they are accorded a $3,000 capital. I'm sorry, they're accorded a $2,000 net capital loss. But if we had the case where the capital gains were $20,000 and capital losses were $24,000, so now you have net capital losses of $4,000, you're only allowed a deduction of $3,000. The excess $1,000 of capital loss would then get carried forward at the trust level on its return. And then before we move on, there's a comprehensive illustration in your book of determining a simple trust taxable income. I really urge you guys to walk yourselves through it. It's actually, it's a page long or a page and a half long. And then that it's illustrated. So the facts, it's illustrated both in the book and also in short form in a blue table C14-2. It says comprehensive illustration determining a simple trust taxable income and tax liability. Those amounts there, I believe, actually tie out with the amounts in the detailed illustration in your book, but it just gives it in a summarized format. I do urge you guys to do that because it will walk you through several different rules that we've covered, like how to determine DNI and then how to determine the distribution deduction. What do you do when you have a trustee fee, some of which is going to be allocable to corpus and some which is allocable to income, and then you might have some of that trustee's fee, like in this example, that's actually non-deductible. Now remember, deductible and non-deductible, that's nomenclature that we use in terms of calculating taxable income. So when I say something's non-deductible, that means it's non-deductible against your taxable income. for taxable income purposes. And that would be the case where you have some portion of it that you would have to allocate to tax-exempt income. So you would then be applying this formula that we went through a few minutes ago up here in your slides, which is, by the way, also covered in your book. So it's a nice example because it walks you through a bunch of different rules that we've covered, and then it just kind of makes sure that you've captured them all in this illustration. And some of your problems are going to be basically like this. So use this illustration for helping yourself to do the problems. Okay. So when we're talking, we're actually now in Objective 6. They didn't give us a nice slide to kind of show us that we're in slide 6, but we are, Objective 6, but we are in Objective 6, which is determining taxable income for complex trusts and estates. And you can probably know that you can probably hear that I'm basically like concentrating on trusts, even though this chapter's on trusts and estates. It's really focused on trusts, as you can see from the problems and all of the illustrations. They're all trust oriented. But the reason they are including trusts or estates in this chapter is because of what it says in the first paragraph under Objective 6, and that is that in general, the rules applicable to estates and complex trusts are the same. The only difference, or one of the major differences, is in the personal exemption that you get. The personal exemption you get for an estate is $600, but for a complex trust, it would be either $300 or $100. It's $300 if the complex trust distributes all of its net income, its accounting income that year, but it's $100 if it chooses not to do that, which is what essentially makes it a complex trust. A complex trust is, a simple trust, you're required to distribute all of your income each year. But with the case of a complex trust, it can choose to distribute all or just some of its income, or it can retain all of its income each year. It can also decide to pay out some of its principal during the year. And there's actually a good example, which we're going to get to in a few minutes. But these examples, I would really urge you guys, as you're reading through the pages here, do go through the examples, because what I have found when you're doing the problems is that the problems typically tie back to one or more of these examples, and make it really, they're really not trying to trick you at all. If you just understand the concepts and then you follow the examples and apply your specific set of facts and numbers to the example, you'll be fine with regard to the problem. So there are some differences between simple trusts and complex trusts. And one of those is with regard to the amount of distribution deduction that they're going to get. So with regard to a complex trust, the distribution deduction is going to be defined as the sum of the total current income required to be paid out. Those are deemed to be mandatory distributions, plus any discretionary distributions made during the year. Those are amounts that can be referred to either as discretionary distributions or quote unquote amounts properly paid or credited or required to be distributed. So the sum of the mandatory distributions and the discretionary distributions is the definition of a distribution deduction for complex trust purposes. However, just like with regard to a simple trust, with a complex trust, the amount of the trust DNI is going to limit the amount of the distribution deduction. So the DNI acts as a ceiling in determining the distribution deduction that you're going to be allowed. There is going, and also as in the case of simple trust, there's not going to be any distribution deduction allowed with respect to tax-exempt income net of allocable expenses. So you're going to have to reduce, and that's where DNI is not going to be, not only is it going to end up being your ceiling, but it's going to end up being in excess of what you're going to be allowed as a distribution deduction, because we know from our definition of DNI before that it actually includes net tax-exempt income, because so does net accounting income include net tax-exempt income. But in the case of a distribution deduction, you have to reduce your DNI by your net tax-exempt income, which is tax-exempt income minus allocable expenses, either directly allocable expenses or indirectly allocable expenses, using that formula that we went through before. Also, if a trust makes charitable contributions, in the case of a complex trust, your DNI is not going to be reduced by the charitable contribution when determining the maximum distribution deduction. However, you do reduce DNI by the charitable contribution deduction when calculating the deduction for discretionary distributions. So they walk you through that. In example 14-22. So in 14-22, we've got a trust that has net accounting income from all taxable sources and DNI, which is exclusive of the charitable contribution deduction, of $16,000. So NAI and DNI, exclusive of the charitable contribution deduction, is $16,000. The trust makes a $15,000 mandatory distribution to one of the beneficiaries, we'll call it Kwame, and it makes a $4,000 mandatory distribution to Keisha. And then the trust also pays a $3,000 amount to a charitable organization. So first we have to calculate what our tentative distribution deduction is going to be, which is essentially the sum of the $15,000 mandatory distribution to Kwame and the $4,000 mandatory distribution to Keisha. So 15 plus 4 is 19,000. And then our DNI is 16,000. That was a given in the facts. And then our distribution deduction is going to be limited to the lesser of our tentative distribution deduction or DNI, because remember, DNI acts as a ceiling for our distribution deduction. So we can never have our distribution deduction be equal to our actual distributions if in fact our DNI is less than that. So that's what that example walks you through. And then with regard to the $3,000 contribution, they're saying that if instead, because in our example those were mandatory distributions, but instead if those distributions to Kwame and Keisha were discretionary, then the $3,000 charitable contribution would be deductible by the trust, and in determining the maximum distribution deduction, you would reduce DNI to $13,000 because that's what it tells you in the rule above. It says that you would reduce the DNI by charitable contributions when you're calculating the deduction for discretionary distributions. So you now have 16,000 DNI minus the $3,000 contribution. So now your DNI would become $13,000. And that would further limit your distribution deduction to 13, whereas you got 16 before in a distribution deduction when those distributions were actually mandatory instead of discretionary. So in total, the beneficiaries, Kwame and Keisha, would report $3,000, which is the $16,000 of DNI minus the $13,000 of, and the reason why your $16,000 of DNI is also equal to taxable income is because it tells us here that the net accounting income of $16,000 is all from taxable sources. So now the beneficiary's reportable amount of distributions in their gross income would be $16,000 minus the $13,000 distribution deduction, or $3,000. That's how much they would report in their gross income. All right. So in the general rule with regard to the tax treatment for beneficiaries in the case of a complex trust is going to be that the amount of distributions includable in a beneficiary's gross income is going to be equal to the sum of the income required to be distributed, which is the mandatory distributions, plus the discretionary distributions. And that's the general rule. Now, we also said before with regard to simple trust that the income is going to retain the character that it had at the fiduciary level, at the trust level. That's the case with complex trust too. So even though they the beneficiaries don't include distributions of tax-exempt income in their gross income, they're still going to get allocated a portion of tax-exempt income out of DNI. And they show how you calculate, how you get allocated that portion of tax-exempt income from DNI. There's an example in the book which shows you that. Also, DNI is not reduced for the charitable contribution deduction with regard to mandatory distributions when we're determining the gross income of the beneficiary with regard to mandatory distributions. That's what we went over with the Kwame and the Keisha example. There are some exceptions to that general rule that I just told you, which is that the amount of distributions from complex trust is includable in a beneficiary's gross income equal to the mandatory plus the discretionary distributions. There are 3 exceptions. The first is called the tier system. And that's where you have a complex trust where the trust instrument requires mandatory distributions to some beneficiaries and discretionary distributions to other beneficiaries. And then some beneficiaries might get both mandatory and discretionary, and some might just get discretionary. So if the sum of the current income required to be distributed and all other amounts distributed, so mandatory plus discretionary distributions, is in excess of DNI, then the amount taxable to each beneficiary is calculated under a tier system. So when you're looking at a complex trust, you would say to yourself, Do I have mandatory and discretionary distributions? Yes, I do. And if you do, and the sum of those is in excess of DNI, you're going to have to allocate your distributions based on the tier system. So beneficiaries to whom income distributions, mandatory distributions are made, those are called tier 1 beneficiaries. And then all of the other beneficiaries are known as tier 2 beneficiaries. If a certain beneficiary is receiving both mandatory and discretionary distributions, they can be both a tier 1 and a tier 2 beneficiaries. Under the tier system, the tier 1 beneficiaries, the ones receiving the mandatory distributions, they are the first to absorb income. And then and the amount of income that's taxed to the tier 1 beneficiaries, i.e. included in their gross income, which is a taxable income concept, is the lesser of all of the mandatory distributions or DNI. And then to the extent that you have some DNI left, then you essentially allocate to the tier 2 beneficiaries in fractions the remaining amount of DNI. There's an example that just talks about it. This is the actual formula that you would use. So the tier 1 is the beneficiary, is the one getting mandatory distributions. So their income that's taxable to them, or the amount that's included in their gross income, is the lesser of DNI or their actual mandatory distributions. And then for the tier 2 beneficiaries, if the mandatory plus the discretionary distributions are in excess of DNI, then the tier 2 income equals DNI minus the mandatory distributions times the income required to be paid or distributed to this beneficiary over, which is basically, it doesn't have to be a mandatory distribution, it's just the amount that's allocable to that beneficiary that's per the trust instrument is to be distributed to that beneficiary over the aggregate of all amounts required to be distributed to all beneficiaries. So it's the fraction just of distributions going to that beneficiary over the sum of all distributions. You multiply that times the difference between DNI and the mandatory distributions to come up with the amount of distributions to go to the tier 2 beneficiaries. That's the tier system. And it's actually walked through in example 14-24. So read through that. That's about Holly and Irene. And I would walk yourselves through that. The second exception is called the separate share rule exception. And in that exception, in this exception, you can have kind of a surprising treatment where beneficiaries could end up reporting gross income on their tax returns in an amount less than their actual distributions received. So in the example in the book, we've got Berry Trust, which was created for the benefit of Dale and John. And under the trust agreement, no income is to be distributed until a beneficiary reaches 21. And the income is to be divided into 2 equal shares. So they own 50-50 shares in the income of the trust. Once they reach 21, then the trustee can make discretionary distributions of income and principal to such beneficiary reaching age 21, But the distributions cannot exceed a beneficiary's share of the trust. That's the rule under the trust instrument in these set of facts that we're given. So each beneficiary is to receive his remaining share of the trust assets on his 30th birthday. So what happens in January 1st of the current year is Dale, one of the two beneficiaries, reaches the age of 21. John is only 16 years of age. So in the current year, the trust has DNI and net accounting income of $50,000. Now we know from the facts that they are supposed to divide income into 2 equal shares. So that means Dale's share of DNI and NAI is $25,000, which is 50% of $50,000. And we're also told in the facts that all of that $50,000 of NAI is from taxable sources. So it makes it a little bit easier. And the trustee distributes $25,000 of income, which is Dale's 50% share, and also $80,000 of principal to Dale. Now, we found in the facts earlier that it said once a beneficiary reaches 21, the trustee can make discretionary distributions of both income and principal to the beneficiary, but the distributions cannot exceed the beneficiary's share of the trust. So he makes these discretionary distributions, and because your distribution is always going to be limited by DNI, that's your ceiling, that means that he's not going to have in gross income a figure more than $25,000, because $25,000 is 50% of NAI, and NAI and DNI equal 50,000. So his 25,000 equals his share of DNI, essentially, which means that that's what that's the amount that he's going to include in his gross income. That 80,000 from the principal of the trust that he receives is going to be included in his tax return as tax-exempt income. It's going to be not tax-exempt income, it's going to be tax-free. So it's going to be a tax-free distribution. So you can see how you have a weird result where you have a separate share rule apply in the kind of situation that we have with Berry Trust. That's C14-25, by the way. And then the third exception is with regard to specific requests. So if you have a situation where you have a specific request, then even if the bequest is made from principal, the beneficiary may still need to report it in their gross income. However, you still have a case where the beneficiary's gross income cannot exceed DNI. So in this case, we have Doug, who died the year before, and he left a will stating that he bequeathed all of his property to his sister Tina. So during the current year, Doug's estate reports $50,000 of DNI. Remember, this chapter's on trusts and estates, so now we have an estate problem. I think this is the only one in the whole chapter where I see something with regard to an estate. So Doug's estate reports $50,000 of DNI, all from taxable sources. Yay, we don't have any special stuff we got to do with regard to tax-exempt income, like allocation of expenses. So $50,000 of DNI. Also during the current year, the executor distributes Doug's coin collection, which is valued at $22,000 to Dina. Now that's actually coming from principal, correct? The adjusted basis of the coin collection is also $22,000, yay. So we don't have to worry about differences between fair market value and basis. The distribution of the coin collection is classified as another amount properly paid. So it's discretionary distribution. And even though the executor distributes nothing from the income account, just the $22,000 of coins, Tina must report $22,000 of gross income. So if the coin collections, and that's, she's not going to have to report 50,000 because she's limited by the amount that was actually distributed to her. Now, if that coin collection exceeded 50,000, which is the DNI figure, then her gross income would be limited to DNI, which is $50,000. Okay, you will see lastly that there's a comprehensive illustration where you determine a complex trust taxable income. Not going to walk you guys through this. We're already at an hour, but I would like you guys to make sure that you walk yourselves through it. With NOL treatment is the same with regard to a complex trust as it is with a simple trust. They remain at the trust level and they can be carried back and carried forward. They do not pass through to the trust to the beneficiaries. And the only difference is that a complex trust's ability to retain income means that there may be more ability to absorb NOLs. Well, that's true, right? Because to the extent that they're not passing through all of their net income to the beneficiaries, they're not going to receive a distribution deduction for that. So they're going to need NOLs to absorb their taxable income to reduce their tax liability at the trust level. So that's a planning opportunity with regard to a complex trust. Also, remember, a trust could be a complex trust in 1 year, and it could be a simple trust in another year. So it can, the complex trust and simple trust are not tax concepts that are codified, i.e. they're not defined in the code. They are actually spoken to in the regulations. And regulations, Treasury regulations, are actually written by a branch of the IRS, the Treasury, or rather, actually, the IRS is a branch of Treasury, but the Treasury actually promulgates the regulations, and those are actually written to further define and explain rules in the code. So it is interesting sometimes that you won't find definitions of certain concepts in the code, but if you go into the regs, it'll talk about these definitions, like with regard to simple trusts and complex trusts. Okay, I told you I wasn't going to discuss IRD, nor the procedural and compliance considerations and grantor trust provisions. I do want you guys to read through that, and I'll talk to you soon. Bye.